This is the Asset Protection Show. Expert strategies by attorney John Skabelund.
Welcome to the show that is all about protecting your assets from lawsuits and creditors, as well as protecting your legacy. After all, what we do is not just for ourselves, it is for future generational wealth that we're creating. Now, a large majority of my clients own real estate investments. While it's critical to protect your investment and protect yourself from lawsuits associated with the property, there are significant tax savings that can be achieved by investing in real estate. Today, we're going to explore one of the benefits in investing in real estate. If you own real estate, you are probably already aware of cost segregation studies and depreciation. Today's expert's going to talk to us about cost segregation studies and the benefits thereof, and more importantly, how to avoid common mistakes. If you're new to investing in real estate, you're going to hear about what are the tax benefits of depreciation, why do we even do it, and what you need to know before you even start investing in real estate. Joe, welcome to the show. Please tell us about yourself.
Well, thank you, John. Thanks for having me. I will give you a very, very quick overview of my path in life. I've always been an entrepreneur, meaning that even when I was in college, I started a business. And then when I graduated from college, I stayed in the business. It was totally unrelated. I was a business management major and I got involved in the travel industry. I sold my business in the year 2000 and I became a financial planner for the California Association of Realtors, which is CAR. And those days, it was a significant organization, meaning I think there are probably 150, 60,000 realtors in California who belong to CAR. And I stayed doing that until 2007-8 when the car went off the cliff. And basically, with the Depression, real estate was my job working for the California Association of Realtors was over. Previous to that, I had done a cost segregation study for two clients who had a big 50,000 plus nut to crack. They owe the IRS 50 grand. They came to me, I put them into a cost seg study. And when the Depression hit, the owner of the company said, well, look, why don't you come and work for me and work in the cost segregation industry. And I switched gears and I've never looked back. Even when it was 2007-8, my trajectory was always going up because I was lucky and I had a lot of investors who had cash. So while other people were suffering, they were buying and they were paying income taxes. So they needed me. And at about 2017, I started my own company, which is US Tax Advisors Group Incorporated. And we specialize in cost segregation and the energy studies for energy tax credits. When you rehab a building and you increase the energy efficiency, you can get a tax credit. So those are the two types of engineering-based studies that USTAGI does.
No, that's great. And do you do this nationwide, Joe?
Yes. We're a nationwide company. My staff is everybody. It's not a surprise. We're everywhere. I have people in East Coast, Central. I happen to be in California. Don't hold that against me. But we're a nationwide company.
That's great. So let's start today by talking big picture. So those who invest in real estate typically are investing in real estate not because it's just an appreciating asset, not just because it produces great income, but there's tax benefits associated with it. So correct me if I'm wrong, but my understanding is the idea is we want to offset taxable income by creating losses through depreciation. Is that right?
That is correct. And real estate is a great investment because not only cost segregation, but there's a lot of great strategies that people who own real estate can take advantage of. I stay in my sandbox, so I don't talk about the other ones, except that that's one of the advantages of real estate is that they're very tax-friendly investments.
Well, that's fantastic. So teach us the very basics here for those who aren't familiar with depreciation. What is meant by depreciation and why does the government give us this advantage?
Okay, so basically, depreciation is the way the IRS looks at a building deteriorating or being, I use the word used up over time. So what can you do? You could wait until you get the expense 10 years down the road and you have to put a new roof on, or 7 or 8 years. But the IRS came up and Congress came up with another technique, which is depreciation. It is not appreciation, which is the increase in the value of the property. It's depreciation, which means that you can expense your building over time as you own it. There are two metrics involved in depreciation. Residential is 27 and a half years. Commercial's 39 years. So what do I mean by that? I mean that basically if you take your acquisition cost, not what the property is worth, what you paid for it, you subtract the land, because land is not a depreciable asset. You got to peel that off, and then you're left, the remainder is the building basis. So if you divide the building basis by 27 and a half or 39 years, you get the amount you can depreciate every year. But obviously I said 39 years. So what are you getting? You're getting a very small amount of depreciation, which is an expense against your taxable income. That's why it's so important. If you have $100,000 in taxable income and you're in the 40% tax bracket, combined state and federal, you're going to be paying $40,000 in income tax. Now, let's say I give you a $50,000 deduction or depreciation expense against your income. Now I've cut your taxable income in half. The 100,000 minus the 50,000 I give you in depreciation. Now you've only got 50,000 in taxable income, and I just cut your income tax bill down to 20 grand, from 40 to 20 grand, all by taking advantage of depreciation. And basically, what we get involved in is what we do, John, is basically the easy way is doing it, divide by 27 and 39. A child can do that. But what the IRS says is the correct way is there's components in the building construction that the IRS give preferential short life treatment to. In the interior building, it's 5 years and 7 years. In the exterior building, it's land improvements for 15 years. So basically what we're doing is all we're doing is peeling off all of those legitimate short-lived assets, and you put them in a pot, stir over medium heat, and you get accelerated depreciation. And that's the value of doing cost segregation. You want that expense to go against your taxable income. That's basically it. Pretty simple to explain.
So you had a lot there. Let's digest that a little bit more. So first of all, you pointed out land doesn't depreciate, so we would cut that right out. Let's take for an example. We had $1 million purchase price of property, and let's say the land value of that's $300,000. So you're saying right off the top, we would deduct the land value of $300,000. We have $700,000 of acquisition cost. And without a cost segregation study, which I think what I heard you say is we're actually just breaking it down to its components. Because if we don't do that, you're telling me that all of it would be depreciated over the life of 27 and a half years, right, for residential?
Correct.
Okay. So you are basically doing a study of breaking the property down into individual components. And Joe, the whole idea there is there's a different depreciation life over different parts of the building. Is that correct?
Correct.
Okay.
Again, yeah, go ahead.
Joe, we'll walk us through that real quick. So what are the common components that we're going to find in cost segregation study? And what are those depreciation life spans for each component, if you will?
Well, let's stay with residential. But again, this can work for any type of building, commercial, residential, any type. And I've done probably every type of building out there since I've been involved since 2007. But bottom line is the interior of the building has lives of 5 and 7 years. Now, what are we looking for? We're looking, by the way, this is the easy, I'm not going to get technical, but the easy fruit to be picked off the tree is going to be flooring. As long as it's not tile flooring, ceramic tile, because ceramic tile cannot be accelerated because that's not a 5-year asset. Ceramic tile can probably last 200 years. So bottom line is, but any other type of flooring, carpet, vinyl, linoleum, and then we look at things like anything that can be basically in just a very simplistic term, anything that can be ripped out of the building and taken with you. So let's say, for example, window coverings can be ripped out and taken with us. Cabinets and countertops. Now it's silly because obviously you're not going to rip out your countertop, but in just layman terms, there are a whole host of these components in the interior building that my engineers know the rules and they find. The outside of the building are what's called land improvements. Those are 15-year items. What am I talking about? I'm talking about concrete cement work. I'm talking about fencing. I'm talking about landscaping. I'm talking about swimming pools. I'm talking about specialty lighting on the outside of the building. So what we're doing is we're dividing out we're taking out the 15-year. We'll have another bucket of 5 or 7-year. And you're always going to have the main chassis of the building staying in 27 and a half years. What do I mean by that? Walls, doors, roofs, HVAC. I can't accelerate that. That will stay in 27 and a half years. So one of the misconceptions that newbies ask is, well, why would I take all my depreciation up front? Because you're not. I'm only peeling off about 25 to 30% of that building basis of the 700,000. The rest of it, you'll still get straight line depreciation. So we're not draining the swamp. We're just carving out the swamp. We're taking the accelerated items and you're staying with 27 and a half year or 39-year property. That means you'll always get depreciation. It's just that in future years, you're going to get less than you would if you didn't accelerate it. But what we're talking about, John, is the time value of money. You want your deductions today. You don't want to wait 27 and a half years. That's bad. And you know this,
Right.
That's bad financial planning.
No, that's helpful. And so let's kind of go back to big picture for a moment. So the whole idea is that, to your point, we're accelerating depreciation. We can't accelerate all of it, it sounded like, because there's components that we can only carve out. But the idea is that we are pushing forward the depreciation as early as possible for the time value of money. Is that correct?
That's correct. And at the end of the day, you're still going to get the same amount exactly to the penny. You're still going to get the same amount whether you do straight line for 27 and a half years or you do acceleration. At the end of 27 and a half years, all the depreciation, guess what? It's the same amount. The only difference is you're front loading it and you're taking the accelerated depreciation in the well, not all of it this year because we'll talk about bonus, but you're going to get it up front in the first couple of years.
Yeah, before we get to bonus depreciation, so let's go back to our example: $100,000 property, $300,000 land. So we got $700,000 or so for the building and its components. I think I heard you say a certain percentage normally that you're able to accelerate by doing the cost segregation. What was that percentage again, and what are we looking at out of that $700,000 remaining?
Okay, so let's look at it this way. As far as the depreciation, every building is different, and we do not take shortcuts. We look at every building, and I'll go into the types of studies we do, but we look at every building. So when I throw out 25%, that's really, I'm being very, don't take me literally. I'm just guessing at 25. It could be 30, it could be 35%, depending on the components inside and outside that building that we can accelerate. So if you take 25% of 700,000, you're going to get $175,000 in accelerated depreciation for this year. So basically what's going to happen is you're going to be left with 525,000 that's going to continue on and for the full 27 and a half years of straight line. You're going to take, though, this tax year, you're going to take about $175,000 because you've accelerated the depreciation. Now, if you want to convert that into, well, how much money am I saving in my wallet, my checkbook? That is a function of your tax rate. So if your tax rate is 100 and is 40%.
40%, yeah.
You're going to save 70 grand.
Okay.
And that's not insignificant. That's a lot of money.
And we're talking about real dollars that
Real
if
dollars.
you owe the IRS due to your W-2 income or other income sources, and you owe $100,000 of taxes come April 15th, you're deducting 70 grand right off that,
Yeah,
owing only 30 grand, right, Joe?
right. Exactly.
Oh,
That's
that's
it.
powerful. That's great. I hope this has been helpful for those that are new to real estate investing to understand the power of the tax incentives that the government is providing you by investing in real estate. Those that already own real estate, this probably has been a review, but nonetheless, hopefully helpful. So let's talk about bonus depreciation. So right now, Joe, my understanding is we're at a 40% tax bonus rate this year in 2025. Is that correct?
2025, yeah, but keep in mind we're dealing in 24. That 25 is not until next year. So my brain is wrapped around 24, and that's 60%.
Okay.
So basically, what happened was with the Tax Cut and Jobs Act, is that they came up with this idea of bonus depreciation. And I'm not going to get technical, but I think I can explain it really easily. If you put in this bucket 5, 15, and 27 and a half years, just the math of those three numbers, 27 and a half, 15, and 5, basically means that the advantage you get is over the first 5 years if you do not have any bonus depreciation, just because of the math. You're going to be able to take the 5 year property at a lot shorter life, quicker. And then the 15 year it's all a mathematical equation. What bonus does is it takes the math out of it. Whatever I find in in any life, 20 years or less, and I've already explained I'm looking for 15 and 5 and 7 years. So that's perfect. Then basically, if you were at 100% bonus, that $70,000 is all taken the year you do the study. However, what happened 2 years ago is it started to reduce from 100. Then it was in 23, it was 80. 24 is 60%. Now, this is a factor of when you bought the building. So if you bought the building in 2020, you're still going to get 100% bonus, right? Because
Just gonna
that's
ask.
when you bought the building.
Right. And so it's critical when you put the property into service, is my understanding. That's when we usually buy the business, buy the property, or Joe, my understanding as well for short-term rentals, for example, is when you started renting the property. Is that accurate?
Yeah, and let me say one thing I should have said in the beginning. I don't give accounting or legal advice. So a lot of what I'm saying is just, my opinion on things. But bottom line is as far as the depreciation, the 100% bonus, you are going to be able to get 60%. And the reason, and so what does that mean? That out of the $70,000, it's not simply 60%. I will just give you some general math. You're probably going to get about $60,000. The other 10 will come over the next couple of years. So in the past, when there was no bonus depreciation, we were selling Cost Seg left and right. Nobody cared. Now with the 100% bonus, everybody's kind of like, oh, it's not 100% bonus. I don't know if I want to do Cost Seg. You're still going to get the benefit, but you have to wait 3, 4 years to get the 100% of that benefit. Is that a big deal? No.
Right.
But
Great.
it's nice to get it all up front. I will tell you that is nice to get. Bada bing, the 70,000 in our example. That'd be nice to get that all up front. But if not, you're still going to get it. It's just going to, most of it's going to come in 24, and then you're going to get a little big chunk in 25, a little bit more 26, 27, until the advantage of the timing is gone.
Right. So in 27, the bonus runs out. But do you think that's going to happen now that we have a Trump administration in place and a Republican Congress and Senate?
I mean, everybody out there thinks that it's a slam dunk. It's going to be the easiest thing to do. My gut feeling is I don't think that the other side of the house is going to want to take that away. There's other bigger fish to fry. So I would be shocked if 100% bonus did not come into effect sometime back to 100% bonus. And the rumor is that they're going to make it permanent. There's not going to be 100% bonus for 5 years and then it's going to drip down and go away. They're saying let's just make it 100% bonus from this point forward. I believe that will happen, but I don't have a crystal ball that works sometimes all that well.
No, I hear you. Now, I think you're echoing what I've heard as far as prognosticators. I also hear echoes that it may be retroactive, and
Yeah.
that would be amazing as well.
Now,
So
keep in mind too, though, real quick, is that, I did allude to this. We can go back 15 years if you have not done Cost Seg. The
yeah, talk to us
government.
about that. So let's say I bought a property 5 years ago.
Mhm.
I never did a cost seg. Is it worthwhile for me to revisit? Can I
Yes.
revisit and do a cost seg?
Yeah, and like I said, I'm coming up with 15 years, but that is just a guesstimate. I've done 17, 18 years when someone bought a building and then they did cost seg. So it's a math equation that I will work out for the client and let them know. What we do, John, is we give everybody a no cost estimate, and then I will give you my opinion. I'll say I don't think it's worth doing. I wouldn't do it if I were you. Or I would say it's up to you. You can do what you want. But bottom line is about 15 years since you acquired the building, so like 2010, the math should work. And what we have to do is we have to calculate how much depreciation you've taken since you've owned the building against how much accelerated depreciation, factor in what you have to pay me and your accountant to see if the numbers work. I like to use a very simple mathematical equation, which is 10 times my benefit. So let's say I'm just making numbers up. I charge you $1,000. I would want you to save 10 grand. If you don't save 10 grand, I will be the first to tell you I wouldn't do it. Now, if you want to do it, fine, go ahead and do it. But my opinion would be, 10 times my fee. And so normally going back 15 years, we can find 10 times the fee.
Well, let's talk about that real quick. So, what is average cost? And I'm sure each property is very different. We have different locations, different features. It might be residential, commercial, etc. But help us understand what is an approximate budget someone should be aware of if they come to you looking for a cost seg.
Well, I got good news and bad news. The good news is that we developed a study called a modeling or analytical study, where basically what we're doing is we are not going out into the field and measuring everything. We're collecting the information from the client, and we can have my engineers working from home instead of flying all over the country, documenting and measuring up buildings. We do a great job at it. Our modeling reports are better than a lot of my competitors' detailed engineering reports. The opposite of modeling will be detailed engineering. That's when we do have to go out there and measure everything. So bottom line is the modeling studies pretty much just overall are going to be $675 for current tax year. If I do a look back study, you've already filed your tax return. I've got to do the calculations that your accountant will file to tell the IRS we're changing methods, we're changing from straight line to accelerated, and here's the math. We've taken this much depreciation, here's the new depreciation, and bottom line is we do that, so we charge $50 more. So bottom line is I charge $725 for a look back study, meaning we go back prior years up to 15. And so there you go. Now there are some glitches. What I've just given you the fee for is like a single family home or a short-term rental, like an Airbnb. That's
Sure.
675, 725. If you start getting into duplexes and tris and quads, the fee will go up a little bit. Not much, but we'll go a little bit because everything that we do is based on engineering time.
Right.
That's the secret sauce. So bottom line is for the modeling studies, I just gave you the fee for a single family home, 675, 725. Then let's go into detailed engineering. That's when I do have to send somebody out in the field. And that one's a little bit more difficult, but that is based on engineering time. And I will tell you that the fee will be anywhere from, I know this is a silly range, 1,500 all the way, up to 10,000, 12,000. If it's like, say it's a 400 room hotel,
Mhm.
well, that's going to be thousands of dollars. That's going to
Sure.
be 10, 12 grand.
But your pricing is remarkable. The last time I did a cost segregation study, I paid close to $4,000, and that was a great price because the others I had interviewed were close to 6 to 10 grand for my property.
Well,
So
what we've got going on here is we've got automation that's taking over. In fact, yes, we are going to be using Chat GPT. And bottom line is all the automation that we're taking into account and we're using is really dropped the price of Cost Seg. So that's the good news. I can't give you a fee unless I look at the building to figure out what kind of building it is. And then I get everybody, I don't charge you guys, I'll give you a fee, and then you can make the decision with your tax team whether it's worthwhile for you to move forward or not.
No, that's great. No, I appreciate that. Now, I assume the strategy of accelerated depreciation isn't for everybody. So tell me, Joe, you alluded to earlier, you might tell the client, hey, this just doesn't make economic sense for you. Who else does this not make economic sense to, or who should not be doing a cost segregation study?
I've distilled it down to a couple of areas. Number one is if you are doing a 1031 exchange, and you don't have any, it's a straight exchange or less than a straight exchange. There's nothing for me because you've already depreciated the building you sold, the relinquished building, right? You've owned it, you've depreciated. By the way, you cannot not depreciate a building. If you think you're being smart and you're not depreciating the building, the IRS will catch up to you and tell you, no, you needed to depreciate your building. It's not a question of should you or shouldn't you. It's part of the law. So bottom line is, as far as that goes, you do need to depreciate your building for sure. And where's I going with that question?
So what about the other kind that a lot of people sell their properties less than 5 years? So is this
Oh,
an ideal
yeah.
thing if you know you're going to be selling this property rather quickly than rather a long-term play?
That was one of the other areas would be if it's a short-term hold. If you're not holding, there is a concept in the depreciation tax law called depreciation recapture. It's simply a tax that you're going to be charged 25% on the amount of depreciation that you've taken. So obviously, if you're accelerating the depreciation and you have to pay it back, so that's why, because I talk all over the country and I'm meeting with financial planners and CFOs, I've distilled it down to 2 years. It all depends on what you can do with a dollar. If you can't do anything with a dollar and you put it in a bank account, a savings account, I will tell you, forget the 2 year rule. Now let's make it 5 years or 6 or 7 years. So what you need to do is you need to use the dollar I save you. Most of my clients, I have high internal rates of return, like 40%. So if I save them a dollar, I figure, within 2 years, is the curve. So 2 years or above, 2, 3, 4, 5 years is the minimum. Otherwise, I will tell you don't do it because of depreciation recapture. The math won't work unless you're superhuman with your internal rate of return.
And
Getting back to 31 exchange where I got off track is that bottom line is if you have nothing for me to look at, meaning that you've already depreciated your building that you sold, so I need value. So let's use simple math. You sold a building for 500,000, you bought a new building for 1 million. Now I have $500,000. Yes, do it. But if you sold the building if you bought your new building for 550, I'll tell you don't do it. There's 50 grand. There's not enough for me to do. So those two reasons alone are the two major reasons. Number one is you're not going to hold the building for 2 years. Number two, you did a 1031 exchange and there's nothing left, there's no meat left on the bone. And then three is if you have a whole bevy of losses and you don't need depreciation, don't do it. You can, but I would tell you, don't do it. Wait until you need me. Like if you sell something and you have a big capital, you have a big tax gain in it, then do it. But don't want people doing cost seg unless they need the losses.
Right. Now that's helpful. And what about vacation homes? I'm going to ask you the silly question, but it's going to be a question a lot of our listeners may have. Is Joe, I have a beautiful vacation home. Can I do a cost segregation study and accelerate depreciation on that?
Yes. And but the rules shift a little bit because the rule with an Airbnb is the Airbnb is not considered a residence, even though your home is on the beach in North Carolina. It is considered a hotel. That's 39-year property. Does it make much difference in the math? No, of course it does, but not enough for you not to do cost segregation. But bottom line is they make wonderful candidates because number one, they're profitable and you should be paying income tax. And then number two is that bottom line is they give special treatment to owners of short-term rentals. In one concept that you might hear about is real estate professional.
Mhm.
And all that means is that the losses I give you are the same type of losses as you are an owner of real estate. So if you're a real estate professional, that means all of my money, all of the losses I give you is active. If you're not, it's passive. Why do you care? Because there's a limit to passive losses. So the good news is you can use them against any of your passive income. However, you may not have any passive income. So if you're a passive investor, you're a doctor who bought an Airbnb, uh, and you don't, it's not producing any taxable income, I will be the first to tell you don't do it. However, I will tell you that a lot of passive investors still do use Cost Seg. And what happens with short-term rentals is that now instead of the 750 hours going to become a real estate professional, if you're an Airbnb owner, it drops it down to 500 hours. So normally you can make the grade and you can become a real estate professional, even if you have another job. It just depends on how much energy is going towards real estate. And the energy definition is 500 hours for short-term rentals.
That's helpful, and I appreciate that. I know we kind of went into the weeds there with the professional real estate investor, but great point there. Going back to the vacation home, do you need to be renting it out? Must it be income producing?
Yes.
Yeah, just wanted to clarify that there. So tell us about those who are familiar with cost segregation studies. What should we be looking at? Again, I was there, I was purely comparing price. In the back of my mind, I'm always worried about an IRS audit. Tell me about what is the IRS looking at when they do audit a cost segregation study, and what are the distinguishing characteristics between a well-done cost segregation study versus one that isn't going to hold up?
Great. Good question. What happened when this all became to the forefront in the year 2000 and well, I'm sorry, it's 1999 when the Hospital Corporation of America won their lawsuit. It took the IRS, the judge said to the IRS, okay, you're going to have to publish a guide because if you believe accelerated depreciation is the correct way, you're going to have to tell everybody why you think it's that way and the rules to the game. So it took them a couple of years. In 2004, they published what's called the Audit Technique Guidelines for Cost Seg, or ATG for cost segregation. If you Google that, you're going to go to the IRS website, and there's going to be an over 200-page report that the IRS gives their agents that tell them what to look for in a quality study. So the most important thing that you should ask your provider is what rules do you play by? If you ask me and my team, we play by the ATGs for Cost Seg. We do everything that the IRS wants us to do to perform a quality study. So bottom line is even our modeling studies all cut the grade, and that's very important because what you want is you want to find somebody who gives you details in the report. In other words, yeah, you could break out 5 items, carpeting, cabinets, flooring, and call it a day and just say this is how much is accelerated depreciation. But when you see a quality report, even our modeling reports are pages and pages long because we are breaking out the components of the building the way the IRS wants us to break them out. So number one, ask them what methodology they use. Ours is the Audit Technique Guidelines. And number two, ask to see a report. Compare their report against somebody else's report. If you see detail, you see pages and pages of schedules breaking everything down from, you name it, all the building components, from wallpaper, from molding, from different ceiling types, different lighting types. You want that detail. One of the reasons why you want the detail is because if you ever do any type of work, anything you throw away in the trash has remaining basis. And guess what? That's a write-off. So you don't need me to calculate the flooring because I'm already going to give you the flooring in my report. I'm going to give you 1,500 square feet, I'm making this up, of carpet. Then if you throw the carpet away 3 years after the study's done, you've got to take the amount of carpet you used up in those 3 years, which is a simple math question. You don't need me to do it. And then you can write off the carpet you threw in the trash. Take advantage of those write-offs. They are valuable. Whenever you throw something of the building in the trash, either outside or inside, that's a write-off.
Well, let me just clarify that. So your cost segregation study is going to break down each component. So for example, you use the carpet. So I rip out the carpet out of my rental. I put in new carpet. tenants as vacated. You're telling me in your cost segregation study, it's going to tell me exactly how much was allocated to the carpet, and now I can totally expense that because I replaced the carpet. Is that what
Correct.
you're saying?
And it's not, again, this is one of these weird deals. It's not an option. The IRS wants you, they mandate you do that. Now, they're not going to throw anybody in jail if they don't take a write-off, because
Right.
obviously you're being pretty stupid not to take a write-off. So the bottom line is it's not an option. They don't want two carpets in the property. What do I mean? One carpet is baked into that $700,000. It's in there, but you don't
Hmm.
know what it is because you haven't done a cost seg study. You
Right.
will when you get my study. And the other carpet is the one you just bought for $12,000. Two different valuations. You want to go to the valuation of when you bought the building and then figure out how much basis is left over. Again, simple math, and then write that carpet off. So now you only have one carpet. You have the carpet that you just bought.
Well, it begs the question now. Let's say we didn't do a cost segregation study. So we're doing the straight line depreciation, and now we are replacing the carpet. So there's no way to determine what the value of that carpet was. So you're telling me that the IRS actually encourages us to do the cost segregation study.
Oh
Is
yeah.
that okay?
Yeah, I mean, all you need to do is go to the ATG for cost seg, that guideline, and just they've got 250 pages of details on what their agents need to look at for cost seg. So, in other words, yeah, they're all in. This is not, you're not going to get audited for cost seg. Those days have gone. You will get audited for something else. I don't know who's doing your tax preparation. You will get audited for something else, and the IRS may ask you questions about my study. They'll look and go, "Oh, you did a cost seg, so let's dig into that." Okay, great. So I'm there to answer the questions. You asked me, and I don't know. This is such I cannot even begin to quantify how many studies I've done since 2007, but it's not a small number. I would guess 20,000. And the good news is that I hate to say this, but I've never been audited.
Never once out of that 20,000 or so.
No,
It's
no,
amazing.
no.
Okay. And I assume you're prepared if there is an audit. What support do you provide to the client and their tax professional if there was an audit and any questions arise about the cost segregation study?
Yeah, I don't charge for this, and I complete audit support. In other words, I will talk to the IRS and I will answer their questions. And
That's
normally that's all it is. It's just questions. I've been questioned, but it's just stupid. How did you come up with this quantity? Okay, this is how we came up with this quantity because here's the plans. And we calculated from the as-built, or whatever. Or my guy went out there and he measured all of the carpet on December the 3rd. That's how he calculated 3,800 square feet of carpet. So I answer their questions. I tell them how we valued everything. We use only the valuation service that the IRS recommends, which is called RS Means. So we use RS Means to do all of our calculations of what all of this cost. And bottom line is our engineers are, they know their stuff, and they're the ones that put together the reports on how much quantities in the building and what's the valuation.
Now, you alluded to earlier when you had told us our price and how you're able to make it so reasonable. You said that the owner will provide you the information. What does that look like? Is that the appraisal, or how is the owner providing you the information about the property?
Well, luckily in this day and age, why we were able to do this is because there is a bevy of information on the web on almost every building. For commercial buildings, I can go to CoStar, and you can go to the for residential Trulia, whatever that's called, and Redfin, and you can find a ton of pictures and information. So number one is the appraisal. So I don't make this very difficult for the owner, but appraisals should be easy to get your hot little hands on.
Right.
If for whatever reason we do not have enough information, I may tell the owner to either you go in and take pictures today or send your property manager and take pictures. I'm not talking about a lot of pictures. I just need a representation of what is in the inside of the building today. And that can be done with 20 or 30 photos.
Well, that's helpful. Any other pitfalls that real estate investors should be aware of when choosing a provider to do a cost segregation study?
Well, the main questions that it's not a pitfall, but be wary, is the number of studies that they say they do. And that's why I don't like saying it. And then how many times you've been audited. I'm lucky that I can say this with 100% honesty and integrity, but be beware of that pitfall, because everybody out there is going to tell you they've done 10,000 studies. That's just the nature of the cost seg industry. Everybody's done 10,000, and then they've never been audited before. So just beware. I would go deeper, peel the onion back a little bit more, and years working for them, or are these pretenders? Are they appraisers? Appraisers aren't engineers. They don't know IRS code. So bottom line is I would just drill down and be sure you're dealing with one of the good guys in the industry. I've seen them all come and go. There are really good ones and there are really bad ones that basically went to this university of MSU, make shit up. That's what they do. And I will be honest with you. I could write a scary good report without even looking at a building, just because of my experience, and it would be 100% wrong. So anybody can make a good looking report. It's, are they willing to stand by their reports? That's key. Are they willing to stand by at no extra charge if you get asked questions by the IRS?
Okay. And you're saying to drill down. So again, not to push back on you, but you said, hey, I've done 20,000, none have been audited. So how does a consumer, a real estate investor, really drill down on a company that sounds great, but when we're trying to compare A, B, and C, well, what other advice would you have? Because they all talk well.
Get a copy of their report. Get a copy of a redacted study. I will be happy to give you my 2 cents, unbiased. In other words, I don't really care because we're busy, and like there's a lot of people out there that want to. Okay, fine. The point is though, get a copy of their study so that you can see. Okay, when I'm talking about detail, compare my report. My reports are about 70 pages long for detailed engineering. So compare it to competitors. Say, I need a redacted report on whatever building you want. Give me a redacted report on a multifamily, an apartment complex, and just look at the detail. Are they breaking down the details in detail, or are they just giving you large caption items like flooring? That's not going to cut it. You can't determine dispositions from flooring. You need to know what that flooring was made of, and the value and the size, the quantity.
No, that's a great tip. I've never thought about asking for a redacted report. So
Yep.
good job. Anything else that real estate investors should know as they look at doing cost segregation study and going this route of accelerated depreciation?
There's one little tip that I blow everybody away when I tell them. Again, I'm not an accountant, but in dealing with CFOs in the accounting world, there's one thing that a lot of accountants don't know, and that is cost segregation reduces depreciation recapture. Now, I still told you 2 years. So I'm not talking about, day 1 to 2 years. The numbers just probably won't work. But I'm talking about if you hold the property, let's say for 5 years,
Okay.
Cost Seg reduces your depreciation recapture, because what you're able to tell the IRS in your tax return is you're able to tell them that basically you carved out, you already know because you did a Cost Seg study 5 years ago, and now you're selling the building, you know what your 5-year property is allocated to. So guess what happens when you sell the property 5 years down the road?
What's that?
You used it up.
Got it.
There's no value left to your 5-year property. So that goes off the table for depreciation recapture, because in essence, you've used up the 5 years because you determined it was 5 years and it's now 5 years down the road. Now you will have to give it some residual value, but don't get caught up in that. Just don't get too cheap. Just give the IRS a number where you can say, okay, if you allocated 5-year property, I make a number of $10,000, then say, okay, $1,000, I didn't, so I'm going to take 9,000, and the $1,000 is the residual value of the remaining 5-year property. But a lot of people don't understand that. And the same thing with the 15-year property. 1/3 of the 15-year property is now off the table. So keep this in mind, everybody, that a lot of accountants don't understand that cost segregation does reduce your depreciation recapture. And to leave you on one note, you can never get hurt by doing cost seg. It's all a matter of timing. So let's say you do cost seg and you don't need the losses until 5 years down the road. Guess what? 5 years down the road, you will be able to use those losses. It's just a matter of timing.
Right. That's a good point there, Joe. We can always use those losses and carry forward and down the road, even if you don't need them this year or the next, right?
Right. They're all net operating losses going forward until you use that bucket up.
Great. I know we're out of time. I'd love to have you back to talk about the energy credits that you alluded to earlier, but tease us with that. Tell us a little bit about what credits might be available, what your thoughts are. I've heard, from the Trump administration, they are scrutinizing energy credits very closely. So tell us, what is it briefly that you do there and how that might help a real estate investor?
Yeah, I'll be very quick on this. Bottom line is, and this is a little bit different from, remember I said flippers don't do cost seg, okay? But if you're a flipper and you did energy efficiencies to your building, you can go back 3 years and you don't even need to own the building today. If you could prove that you did the work, you have the receipt for the HVAC, you have a receipt for the the electrical appliances that you upgraded and the light fixtures. If you've got the receipt, you can go back and get the tax credits. Bottom line is it's a moving target because we're now in the third year, but I'll make it simple. You get anywhere from $2,500 to $5,000 per door, depending on when you did the energy work. So if you go back 3 years, it's going to only be $2,500. 2 years up till today, you're going to get closer to $5,000. So bottom line is, there's 3 areas of the building that they look at. They're looking at the envelope of the building, doors, windows, insulation, roofing. They're looking at appliances and light fixtures, and they're looking at HVAC. They're looking at the air conditioner. I like to say that if you did replace your HVAC system, most likely you are going to qualify. If you didn't, you still could qualify, but now it gets a little bit tougher because you've got to make up for it in your insulation and your water heater and all of that. The low-hanging fruit is if you did put in a new HVAC, and the good thing about this is that you really can't buy building components nowadays that are not energy efficient.
No,
I mean, Home Depot's just not selling, crap anymore. Because why? Because the states and the counties won't let them.
That's fantastic. So just to tease everybody, we will have another podcast for our real estate investors that do fix and flips about energy credits. We'll also have another one with a tax professional to talk about professional real estate investor status. What are the requirements? Who that's ideal for? But Joe, before we let you go, how should people contact you?
It's pretty simple. U.S. Tax Advisors Group Incorporated. We've shortened it to USTAGI, and a lot of people know us by USTAGI. But basically, it's USTAGI. Just go to the website. They can you can set an appointment with me. I'll be happy to talk to anybody who needs, at no charge. I'll just give you my viewpoints on Cost Seg. I'll give you my viewpoints on anything you want to know my viewpoint on, whether I've heard of a competitor. I don't like to go down that road, but I'll tell you the truth. If I haven't heard of somebody, I'll say I've never heard of them. And that doesn't mean it's bad. It just means I'll give you my opinion, and then you can take it to whichever way you want. I just want, the consumer, my clients, just to know that Cost Seg is out there, and that if you ever get asked owning real estate to write a check to the IRS, go to USTAGI.com.
That's great. Well, Joe, thank you so much for your time today. Listeners, I hope you've benefited from this and from Joe's wisdom here. Whether you're already invested in real estate, this is something you should consider. If you haven't invested in real estate, it's a great place to make a lot of money. But as we've talked about previously, you have to protect yourself from the lawsuits that could come from owning real estate, as well as losing that investment. We're talking big dollars, and it's not hard to take investment real estate away from you if you're sued. So continue to be safe and tune in next week. Take care.
You've been listening to the Asset Protection Show, expert strategies by attorney John Skabelund. For more information, go to assetprotectionshow.com.
This content is legal information only and not legal advice. Viewing this content does not create an attorney-client relationship. Mr. Skabelund is admitted to practice law in Arizona, and he may be reached at ultimateassetprotection.com.